So, you ever see a company post a great earnings number and then the stock just tanks? Well, that's exactly what happened with First Internet Bancorp. Their Q4 earnings were a real head scratcher. We're going to dig into why a solid quarter on paper got such a cold shoulder from the market. Let's jump in. Okay, so here's the paradox right up front. Look at this. On the left, GAAP EPS. They knocked it out of the park. A 17.6% beat versus what the analysts expected. That's huge, right? But then you look to the right. Revenue. A miss. So you've got this classic tug of war. The bottom line looks great, but the top line is a little weak. What gives? And the market? Well, it made its decision pretty quickly. The stock dropped over 2% the very next day. So clearly, investors weren't popping the champagne over that earnings beat. They saw something else, something that spooked them. And that's exactly what we're here to unpack. All right, here's our game plan. We'll start with this whole earnings paradox. Then we'll unpack the numbers, the good and the bad. After that, we'll get to the real meat of the story, what I'm calling the credit cleanup. And finally, we'll look at management's playbook for 2026 and wrap up with our own take on what's next for the stock. Okay, first up, the earnings paradox. It's a question as old as the stock market itself, right? How can a company beat expectations and still see its stock fall? Well, here's the answer in a nutshell. The market is all about the future. It's not about what you did last quarter, it's about what you're going to do next. And in this case, investors looked right past that shiny EPS number, zeroed in on the company's forward guidance, and they saw a major red flag, one big enough to eclipse all the good news. So before we get to that red flag, let's look at what was actually working. Because honestly, the core banking business, it looked pretty darn good. I mean, just look at these numbers. Their net interest income, that's the bank's bread and butter, was up a whopping 29% year over year. Their margin expanded by 55 basis points, which, is just bankers speak for they're making a lot more profit on every loan. Plus, they're growing their loans. These are really solid, healthy numbers for a bank this size. No two ways about it. And then you've got this whole other side of the business, their tech side. The banking as a service unit, or BaaS, is just absolutely crushing it. It vacuumed up over $1.3 billion in new deposits just in 2025. That is some explosive growth. This is what separates them from your typical old-school regional bank. They're basically a fintech company with a bank charter. And get this, it's not just about collecting deposits. They processed over $165 billion in payments. That's a 225% jump from the year before. We're talking about a massive, high-volume payments engine humming along in the background. That's the power of their digital strategy right there. Okay, so the core business is strong, the tech business is on fire. So what's the problem? Well, now we get to the messy part. Section 3, the credit cleanup. This is where all that market anxiety is coming from.
Yeah, so what is spooking the market so badly?
You don't even have to guess. Management came right out and said it on their earnings call. Quote, "After further evaluation of the problem loans, we are guiding to a higher provision for 2026 than we initially estimated." Oof. When a company tells you they're setting aside more money than they thought to cover bad loans, that is a 5-alarm fire for investors. And here it is, laid out in their guidance for the next year. You see the loan growth, that looks good. Then an interest income, also solid. But then, there it is, the provision for credit losses. $50 to $53 million. For a bank of their size, that is a huge number, and it's the anchor that's dragging down their entire earnings forecast for 2026. Now, here's a really important detail. Management went out of their way to say this isn't a widespread problem. The issues are really concentrated in just two specific areas: their small business administration loans and their franchise finance book. And even more specifically, it's the loans they wrote back in 2024 and early 2025. So they're trying to ring-fence the problem. All right, so they've identified the bad apples. So what's the plan to deal with them? Let's dive into management's playbook for 2026. Okay, so it looks like a 4-step plan. First, they're going to front-load the pain. Basically, rip the Band-Aid off. Take all the big hits in the first half of the year and get the books clean. Second, while they're cleaning up, they're going to push hard on growth in the healthy parts of the bank. Third, they're still aiming to expand their profit margins by the end of the year. And fourth, this is a fun one, they kind of dangled the M&A carrot out there, saying they entertain all inquiries. A little hint that maybe a sale isn't out of the question. Okay, time to put it all together. What does this mean for the stock going forward? This is our take on the next call. But first, let's just get some perspective here. This chart really says it all. Over the past year, INBK is down almost 39%. Meanwhile, the broader regional bank index is up nearly 33%. That is a massive, massive divergence. It tells you that the market has been punishing this stock for a while, and its patience is wearing really thin. And that leads us to our call. We're putting an underperform rating on the stock. Look, the thesis is pretty straightforward. The market is officially in show-me mode. Talk is cheap. Investors need to see hard proof that these credit problems have actually peaked and are getting better in the second half of the year, just like management promised. Until then, we think the stock is just going to keep lagging. Okay, but what if you're a gambler? What if you believe management? Let's have a little fun with a trade idea. It's a concept called vintage risk arbitrage. It sounds complicated, but it's not. It just means you're betting on a specific timeline for when a bad batch of loans, a vintage, is finally cleaned up and resolved. So here's how you might play it. 1, the thesis. You're making a bet that management has this under control, and things will look much better by the second half of 2026. 2, the action. You could buy some long-dated call options, think January 2027, to get some leverage on a potential recovery. And 3, the hedge. Because you don't want to get wiped out if all banks go down, you could short a regional bank ETF like KRE. That way, you're really just betting on INBK's comeback story, not the whole sector. So, to wrap it all up, what you have here is a really exciting digital growth story that's being held back by some old, messy credit problems. The big question for the next earnings call is simple. Is the cleanup on track? The stock's entire future really is riding on that answer. And of course, this is not financial advice.